We're going to go ahead and get rolling. My name is Dustin Miles, and my co-host is Hayden Harrington.
Yes.
And a lot of you folks have been to our Momentum meetup over in Las Colinas for the Dallas local people, and we're honored to have Merrill with us tonight. Busy guy in high demand, and so we're going to kind of talk about from a legal perspective what you should look for in contracts and things like that with navigating the coronavirus. So let me pull up the charts real quick, and we'll get going. Just one second. Let me share my
And I guess if anybody has questions along the way, just hit the raise your hand button and we'll be sure to unmute your microphone so you can ask any questions that you may have for Merrill.
Except questions regarding the NSA.
Okay. All right. I might go ahead and.
Okay, come on, you guys pay for all this stuff, yeah?
All right. So Merrill, I'll let you kind of take it away here.
Okay. Dustin, I'm not sure. I don't really see anything on the screen, but.
Okay. Not sure what's going on. Hold on. Okay.
Maybe go back a couple slides, but.
Okay.
Sorry. Okay. Hey guys, I actually know quite a few of you that logged in, and for those of you that don't know me, my name's Merrill Kaliser. I've got my own law firm, Kaliser Associates. We've got 3 lawyers, 3 paralegals, and most of our practice is real estate syndication, commercial real estate work, and SEC and blue sky filings. We typically are a flat rate firm, go from A to Z, from LOI all the way through closing. And my former training was as a commercial bankruptcy and restructuring lawyer for a pretty large local firm called Gardner Wynn, which is subsequently merged. And so I was involved in Enron and WorldCom and Blockbuster and Kmart and probably about a dozen smaller oil and gas companies during the 2000 to, or actually 1999 to 2008. Unfortunately, I'm getting a lot of questions regarding asset protection right now, and people sitting on cash and what to do with forbearance agreements and similar questions to that. One thing that Dustin and Hayden want to talk about, which some people may think is counterintuitive, talking about structuring LOIs and structuring PSAs. And as we had a quick offline conversation, I jumped into single family real estate back in 2009 with some large private equity groups. And we were buying tons of properties when the world was going to hell in a handbasket. And the opportunities out there were unbelievable. Now, you do take some risks, but ultimately financing is there. Ultimately, there's capital that really enjoys jumping in at some of the pricing we're going to see. My guess is starting in mid-April and May. So I think this is actually quite appropriate while everybody else is talking about, small business administration loans and what the CARE Act's doing and what's happening to tenants. That's extremely important, but there is a particularly growing segment of syndicators out there looking at opportunities that are showing up right now. So it was a great idea for you guys to put this on. So there we go. Number 3, which you guys, it's just taking a little bit while to come up. So one of the things we have worked on, my firm has worked on, and this, I'm gonna have to say this is not legal advice. This is for educational purposes only. However, this is a fairly highly negotiated material adverse provision that you would see normally in a PSA, but we include it in all of our clients' letter of intents and my own as well. I'm also a syndicator. This has evolved and it continues to evolve. This is kind of protection for both the buyer and the seller. The reality is there's a lot of things that are going on right now that are beyond anybody's control, that are either federally mandated, state mandated, or locally mandated, aside from the fears of the lenders and the sellers and the brokers. So I can read this verbatim. It's probably not important to read it verbatim. We can make this available, this PowerPoint available to whoever wants to at the end. I'm fine if you guys want to do that. And you're welcome to use this provision. I would have a lawyer look at it before you actually stick it in an agreement, because this was one of the ones that I was working on for one of my own deals. Our clients used this or very similar provisions to this. As expected, you've got to get depending on which side you are, you've got to get both parties to agree to this provision. It's fairly evenly tailored, which normally you wouldn't expect coming from a lawyer. It's normally gonna be one-sided or the other. But basically what it does is it builds in some kind of gap stops, primarily around the due diligence period, because that's the most difficult thing people are finding right now. Me personally, I have a tolling period on due diligence because we found out 3 residents in an apartment complex where we have under contract have tested positive for coronavirus. So aside from what I thought I could get people to go out and do, now I'm not having anybody go out and do anything on these until that's resolved itself. So this type of provision, I call it an adverse effect provision. It's not your normal material adverse effect provision. It's not a force majeure provision. Those are force majeure provisions, which are what we call act of God. You know, like a hurricane, a nuclear weapon blows up, which would not really be an act of God, but you know, some catastrophe. It's got to be very specific, and the courts construe it very specifically. So in line with that, we created what's called a COVID-19 adverse effect provision. It doesn't supersede any of the other provisions, but it's designed to provide some comfort and some protections for both the buyer and the seller with shelter-in orders and state of the emergency orders that continually change on a daily basis. Dustin, I didn't know if you had any questions or Hayden had any questions regarding those.
I got a quick question actually about that. Do you think those provisions will be kind of generalized and standard in PSAs moving forward?
Yep. I think they will. I think what'll probably happen is you'll have your force majeure provision, which is basically an act of God provision that's pretty specific. And in a perfect world, I would incorporate a less verbose version of this with my force majeure provision. I can tell you all of my clients going forward will have this in their agreement, because there's a chance that this could come back around in to a lesser extent next fall or winter. And if certain areas decide to have, you know, smaller shelter-in provisions, we're already aware that this can happen. So now that we're aware it can happen, we need to protect each other from it.
Right. Gotcha.
John,
Well, my question is are any provisions set up to clean these apartments from the health department? So if you comply with the health department for cleaning, because it's supposed to have like a 24 to 72 hour existence outside on the surface, from what I've read.
Yeah, so right now there are no provisions unless that's negotiated in the PSA. And I think anybody that's doing that now is not going to rely on 72 hours. They're going to want a longer time frame based on the different materials supposedly that it can last on or can't last on. That has not been addressed right now, quite honestly, because I don't know if every closing we've had that was supposed to close in the last 2 weeks has been pushed by at least 30 days. Mm-hmm. Part of it is because they can't even get into the units because either they're fearful or the sellers are fearful that a tenant might infect a third party that's doing due diligence and get sued for it.
Yeah, I talked to a gentleman today and he was telling me he's got new construction, but he has to pay whoever the service person the time that they wait for the actual power to come on or water to come on. So instead of them going in, because they're not going to even go in the building. And he said it's new. He says it doesn't matter anymore.
Yep. Yeah, the whole world's afraid.
Yeah.
This is all fear driven right now.
Yeah, too many unknowns.
Any
You guys
other
want to go to the next slide, or did you have a question, Dustin?
any other questions from folks before we move on? You can raise your hand and then I can unmute you. I guess the only question I had is, because a lot of this is evolving pretty quickly. I don't know if you guys have had any clients that were, more recently under contract and then all of this kind of fell apart. If you've had any instances like that, or have people been able to get out of the contract, or, not sure what you guys have had, Merrill, but if you could speak about that.
Sure. And one thing you guys that don't know me will figure out, I'm a very transparent person. Some people like it, some people don't. So I'm going to kind of give you guys the good and the ugly, at least from what we're seeing from our firm. We had I'm going to guess about 26 syndications that were in the works, probably 28 syndications that were in the works. And I would say 14 of them went under either LOI or PSA in the last 3 weeks. And of those 14, 3 are going forward. So to back that up, almost everyone that was set to close the end of March or beginning of April has been pushed back. One, because of the new parameters that Freddie and Freddie Small Balance, actually Freddie and Fannie and HUD have now required with respect to the escrow reserves. So you've got a lot of syndicators that are trying to raise more capital in a not so friendly environment in raising capital, at least with respect to kind of the groups that we all hang around with. So I've had a few people walk from about 250 grand against kind of our suggestion. I think patience, which I put at the end of almost every one of my posts, will cure a lot of this. And there's so much fear. People just want to rip the Band-Aid off right now without waiting for some of this fear to subside and this to normalize a little bit. There have been a couple sellers that have been very gracious and actually allowed the buyers to get their hard money back with the hopes that they'll come back to them. It's not the majority by any extent, but there have been a couple. Me personally, I'm on 2 deals that are quote unquote on hold. I've got 2 LOIs that have been accepted. I won't draft the PSA, and they've agreed not to take other offers until the state of emergency has been lifted. So, it's the entire gamut. Anybody that's getting under LOI or PSA right now, we're having them, and we'll get to this on the next slide, but I can tell you guys, we're having them go into, 60-day due diligence period subject to, this COVID adverse material effect provision. We're having financing contingencies built into these. This was the norm 3 years ago. There's no reason why they can't do it now. And so we're seeing sellers accepting financing contingencies, which would not have happened 3 weeks ago. We're building in 2 20-day, if we can get 30, great extensions on closing dates on top of the financing contingency. Because we don't know what we don't know, there may be last minute changes in reserve requirements or other requirements, or a lower loan to value at the last second by some of these lenders. So we're building in some time for our buyers to go and raise additional capital or decide whether it's not worth it because it changes the deal, and make that determination whether they walk away from whatever money has been hard or not.
Okay. I'll go ahead and move on to the next slide, which you just kind of hit on most of this stuff. But
sure, I don't mind going over it again. But one of the primary things is buy yourself enough time to close. So it's not just the lender. You have scared investors right now. Some are savvy. Some understand that it still should be one of the safer places to put your money, and eventually people will go back to work and businesses will run again. We just don't know how soon. but at the end of the day, people want to work, and the government's not going to continue to hand out money forever, at least on the mass scale they're doing now. So buying yourself some time, if you like the deal, great. I put typically you want to make sure that the extensions do not require you to put additional funds in. We try to do that. If anything, we allow them to release some of the earnest money. If any additional earnest money has to go in, it doesn't increase the purchase price. It's applicable towards the purchase price. With respect to the force majeure, we already talked about that should still be in your provisions in your PSA. We're not allowing any of our clients, to be honest with you, to do anything without a COVID-19 specific provision because of what's going on. Listen, I can tell you guys from firsthand knowledge that in the last 3 weeks, sellers' expectations of pricing has dropped. It will drop more in the next 15 days, depending on what percent of their rents are actually collected. But we're kind of fortunate to come off of a period where lots of people were jumping into these 2 and 3 years ago with bridge loans and short-term loans that are going to be coming due very soon, and they're scared to death. And they can't refinance maybe because their occupancy rate or their economic occupancy is too low. So it's going to create, and it's already starting to create some buyers opportunities to the extent the buyers negotiate their PSAs in a way that they're protected. We're seeing some favorable deals coming around. I've got some clients that are starting to realize, pushing some of these out, closing date out 90 to 120 days, we could be in a completely different world in 120 days, hopefully a better world. I can't imagine it's going to get much worse, except maybe in May we'll show a higher unemployment than we have now and a higher economic vacancy. But I believe, based on what I'm reading, that'll turn around in June. I'm not an economist.
Well, depends on
John,
the tiering. Depends on the tierings, that's going on. The small businesses, the ones that are basically on the edge, they probably will disappear. The large corporations, they're going to be there. The mid-sized corporations will probably be there. And anything within that range between mid and lower, pretty much going to be in trouble for a period of time.
Right. But as history has shown itself, when small businesses go away, other small businesses pop up and replace them. Right. Thank God, that's kind of the way our society is built. It's kind of like insurance rates down in Houston. The big companies have almost made it prohibitively impossible to find deals because they keep increasing the rates. You've had some new companies step in that are offering unbelievable rates. They just create opportunities for others. So I agree with you. I think some small businesses will be hurt regardless of the SBA, which I'm giving a webinar on tomorrow, some of that. However, it's just going to create more opportunity for others, or these businesses will go away and they'll just form a new business. So I'm not as concerned about that, but I think the short-term damage is going to be pretty big.
Cool.
Next slide, unless anyone has any questions.
Yep. Here.
So this is actually an interesting question. I'm talking to you as somebody that doesn't believe in putting hard money down on day one. So I'm coming at it from a completely different perspective than I would say 90% of my clients, or 90% of my clients as of 3 weeks ago. I fight as much as I can not to put hard money down on day one. I don't care how good the deal is. That's just my own personal issues as a former corporate bankruptcy and restructuring person. I assume the worst in everything. So I try to keep my money, or my investors' money, as safe as possible. However, you guys will laugh. I was pissed off that I got 2 deals in Amarillo. I had to put $5,000 hard on each one of them. And it really, really pissed me off. And my partners were laughing. They couldn't believe I negotiated that low. And I was pissed that I was giving up $5,000 after I had bought 14 days negotiating a PSA, and we really had done all of our due diligence. But it's a fundamental issue with me. But right now, we're in a time frame where I have seen 3 deals that have been accepted in the last 2 weeks that have no hard money down during the due diligence period. And so, guys, I'm telling you, we're making an offer on something tonight with a 60-day due diligence period with no hard money down. And there are 2 other groups, my understanding, making offers with the same basic provisions. And the seller is going to entertain one of the 3 offers. So I don't think listen, it's not a seller's market right now. It's a buyer's market if the buyer's not too afraid and the buyer is able to raise capital and gets a fairly good loan to value, I would say a lower loan to value loan. But if you have the ability to go and take more assets, you hold all the cards right now. So if a seller is adamant about hard money down, I'd talk to them on April 18th or April 19th after they've collected their rents and see how adamant they are about their hard money down. The next slide is the best slide. I don't know how many people remember buying deals when there were no financing contingencies. I mean, when there were financing contingencies. That's on the table on every LOI that we've seen in the last week. So just because we've only had about 3 or 4 deals actually go through, we've had clients submitting several LOIs, and every one of them has financing contingency. And there's not a single seller that we've run into in the last couple of weeks that's balking at it because they're seeing the same things, because one of the options many of these sellers have is to refinance. And so, because a lot of these are 3-year bridges or finance out of them. And so they're seeing the same type of terms and same type of conditions that the buyers are getting quoted on. So there's no real, there are really no games being played here. It's a lot of reality going back and forth. So I would absolutely encourage you guys, if you're moving forward on something, you include a financing contingency in your deal. And what I tell our clients, and I tell myself this, I'm very competitive. It's okay to lose a deal. You'd much rather lose a deal or walk away from a deal than lose money. The name of the game is capital preservation, number one. And the deal, it's your deal. It either works for you or it doesn't. And so if you're adamant and your investors are adamant about having a financing contingency, don't budge. Let someone else take it. It's okay. There will be so many more deals. You guys are going to see tons and tons of deals pop up in the next 6 months. And so, again, I would strongly encourage whoever your real estate lawyer is, or your syndication attorney, or if they're doing both like we do, if they're not pushing for it, you guys should try to have this in your LOIs. You should just have a standard LOI that has the COVID provision, has this in it, has a 60-day due diligence subject to tolling, which just means you're stopping the time frame. You're stopping the due diligence critical dates. And, when there's a state of emergency or there's a shelter in, everything stops in time. And then it picks back up. The critical dates just move back the amount of time it was stopped, and you move forward. There's no reason for you guys to enter into anything other than that right now. If someone's making you do it, it's a big gamble for you. Very big gamble. Any questions?
Any questions for folks?
Anybody awake? Lawyer speaks. It gets kind of boring.
Yeah. I don't remember. Is there anything after this slide? I can't remember.
Yeah, it was a Q&A.
Oh, okay. Okay. Well, there you go. I guess one, just question I had, and most of the people on here are sponsors, so there's a few passives, but things have, obviously someone put out a pro forma, especially if it was, earlier this year or maybe late last year, and then they're closing fairly soon. What sort of, at what point, I know we chatted about this before, at what point can an investor, passive investor, get out of a deal? When, potentially, I guess the performance changed, a decent amount.
Yeah. So can I clarify the question?
Yep, go for it.
So I think Dustin's asking in non-legal English is basically you're raising capital, you've collected the capital, and now the deal doesn't look as good as the deal was 2 months ago when you're getting ready to close, and your investors want out. So this is not really an SEC question. This is going to be a question that goes back to your company agreement and what it says in your company agreement about redemption or selling your shares, and whether it's mandatory or whether it's voluntarily. Mandatory meaning you can put those shares to the manager and they give you back your capital. Most documents, most company agreements that we draft do not have those provisions in them. My personal funds, when I do them, we have a discretionary redemption provision. Basically, if somebody needs to get their money back and it doesn't adversely affect the fund, we'll pay them their money back. But that's what I do in my deals, and that's not the norm in the majority of deals that our clients syndicate. So in a very harsh, non-emotional answer, the answer is too bad. They invested in it. Unless you're willing to kill the deal, excuse me, and then if you kill the deal, there's going to be some hard money loss, but in theory, that should be what the manager absorbs, not the investors. Just because the investor is nervous, the first instinct is too bad. Now, the reality of that is it's not fun having an investor or two or even 5 or 10 that are very unhappy about being in your deal. We've all been there. And if you guys haven't, you're lying. Not everybody is always happy. You're always going to get 1, 2, whatever, that for whatever reason, they're not happy. And so our general advice is when that does come up, to the extent you can, return them their money. Make it an exception, return them their money. If you're moving forward with the deal, obviously, you don't want somebody who is going to create more issues than you already have going on. But as a passive, I'm just telling you guys, there's not a lot you can do if you've already put your money into the deal and they want to move forward. You can complain to the syndicator. In theory, you could try to find out if other passives feel the same way. That's not good for syndicators, but there's a lot of things you can complain about and be a pain in the ass, excuse my language, to the syndicator, so that the syndicator just wants to give you your money back so you can go your own way, and you sign a non-disparagement agreement and a confidentiality agreement so no one really knows about it. I say this because we've had several clients that have needed that. But there's no legal right for the passive to get their money back unless it's called for in the company agreement, or the syndicator's committed fraud. That's a whole nother topic that I don't think you want to talk about right now.
Yeah, sounds good. And so, there's most of the people on are syndicators. So especially now, I think we all know the answer, but especially now, if people are about to put an LOI, I assume that's before putting in the LOI, they should talk to you, make sure they have all the right language in, and before even, that stage.
Yeah. And one of the things we do, probably shouldn't, but we don't charge or engage anybody to do the LOI. For the most part, it's typically going to be your broker that structures the LOI. Some of you may do your own. We ask anybody that's thinking about using us, send us a copy of the LOI. Let us just look at it real quick. 99% of them are going to be fine. If we make a suggestion, hey, you might want to put in this provision in your LOI, like the COVID-19 provision, great. We might want to help you tweak some stuff. It's not good for business, but I'm not charging anybody for it. We're not signing an engagement letter. And in theory, it's not legal advice. It's just educational and for business development, I should say. Because the reality is there are going to be 10 LOIs or 8 LOIs put into a deal. Only one is going to win. We'd like you to have the best opportunity you have while protecting yourself and your investors. So we have lots of clients and even non-clients that ultimately become clients if they win. Send us LOIs to do a quick review. Depending on how busy we are, it takes 5-10 minutes. Luckily, LOIs are not that complicated. But even though they're not binding, the reality, as all of you syndicators know, everybody goes back to the LOI when there's an issue. Even though they're not binding, when you're negotiating the PSA, everybody goes back to the non-binding LOI, which is entertaining as a lawyer.
Okay. Any other questions for Merrill?
I'll put something out there too, Dustin. One thing I would suggest to you guys, this is more of business advice. I give a lot of business advice because as a former corporate bankruptcy and restructuring lawyer, 50% of your advice is business and 50% is legal. So it's just kind of what I've seen over the years and what I'm seeing now. You guys are looking to do an LOI, go ahead and do a poll of your investors. I don't care if it's a Survey Monkey or whatever, do a poll of your investors to find out if they're interested in investing, how much, how quickly. It's anonymous. I think it's very important. Don't put an LOI out there and really have no clue whether you have any remote chance of funding the deal, because then you're going to get bad will. You're going to earn bad will very quickly with the brokers out there. And the brokers are very, very, very hungry right now. Brokers are even cutting deals on some of their fees with sellers right now just to get deals done. So again, my recommendation would be to definitely do polls. We do them regularly, and believe it or not, your investors actually appreciate it. They don't know. I'm getting people calling me right now. Are you guys investing? Are you guys taking more capital? Are you, and you wouldn't expect people asking that, but there are a lot of people that went through 2008, 2009, 2010, pulled their money out of the market, know what happened with residential, with single family, and they're seeing what could happen with multifamily on a temporary basis. It could be a feeding frenzy for the right capital. And guys, there is a enormous amount of capital sitting on the sidelines right now. Enormous amount.
Did you have a question?
Yes. First, thank you, Dustin, Merrill, and Hayden, for the information. Very good information. Merrill, question. You mentioned, the prices are going to be much better than, it was a couple of months back. Next 6 months, it's going to be better. So, but what class specifically? Like, is it going to be all ABC class or only certain class? You think the prices will see more variations, Merrill? So,
listen, I've probably listened to as many economists as everybody on here has listened to, and as every brokerage has got their own opinion right now. So, I'm going to tell you, I don't have a crystal ball. I can tell you what my gut tells me.
Sure, sir.
My gut tells me that A class is not protected like everybody says it is, number one. Okay. Me living in a high rise in Shops of Legacy and paying $6,500 a month in rent, I know for a fact that there are people not paying rent today.
Oh.
Okay. So I'm telling you, nobody is protected. What I believe, and this is me looking at numbers, looking at trends. I love data. Most of you know me. I study KPIs all the time. We create our own. I think B and C, especially C, will be hurt the most initially, but I also think C will be the quickest to come back because they're They're your workforce. They're many of them are day laborers. Many of them are working at Walmart and at Starbucks and waiting tables and bussing tables and doing yard maintenance. And this is not to be derogatory by any means, but these are the jobs that really have been, and maid service that have been just kind of cut. Those are the first jobs that are going to go right back. And so the people that are paying $6,500 a month, which is an absurd exaggeration. I don't think anybody on this call has tenants like that. If they do, I want to learn from you. Yeah, John's got them. But I know I'm kidding. But I think that goes up to, you know, your $1,500 to $2,000 a month rents. Those people that lose their jobs, not going to be as easy for them to get their jobs back. And so I still believe in workforce. I think it's going to take the quickest hit. I think it's going to be a nice price drop because sellers are just going to get nervous, and the many sellers are going to have to refinance. And they never intended to actually property manage or asset manage these long term. That was not their goal. So I think they're going to be opportunities, whether you're getting them before they go into default, whether you're buying a note or assuming a note from Fannie or Freddie, which could be a very good opportunity, or quite honestly, go to the courthouse steps. Those are the best opportunities because you're getting the property free and clear. But that's not going to happen for a long time. The last thing these lenders want to do right now is take back these properties. They saw what happened in 2008 through 2012 in residential, in the housing. They do not want these properties at all.
Yeah, so thanks. I really appreciate
Sure, thank you. Good talking to you.
And in most cases, I've seen some of those properties that went back to the bank. They were pretty destroyed by people that got kicked out.
Yeah, I bought about 2,900 at the courthouse steps over a 4-year period in 4 states. Those are our best deals. Listen, you get what you pay for.
That's right.
If you're smart, and again, it goes back to, like, I'm working on an opportunity fund with a couple other investors right now, a couple other, sponsors. The investors that we're taking into that fund, and it's a 506c, so I'm not violating any SEC provisions. But what we're going to take into that fund are investors that are ultra high net worth accredited investors that seek out opportunities like this, that know, hey, listen, we may only be leveraged 50% right now, or even 40% right now, because that's all the banks will give us. But we know we can refinance out in 3 years after we put CapEx in and turn these puppies around. So, you know, at the end of the day, price dictates everything. And it's just, we're all navigating right now through this just massive fear that's going back and forth. And, you know, one minute everything is great. And then you get a news report and it's like, oh my God, I'm going to die tomorrow. Or no one's going to pay rent tomorrow. Okay. Here's the reality, guys, especially, I think most of us own B and C, maybe some C-, but I think most of us on here are B and C type people, depending on what you classify an A as. You know, if April and May are 20% economic occupancies, I will almost guarantee you the government is going to issue bailouts for us. The banks cannot handle foreclosing on this. There's no way they can handle it. They've got no property management that can do it. It will be a nightmare for them. So I think what the government is doing, whether you like what the government is doing or not, I think they're taking a wait and see what this stimulus package does. It's unfortunate that the money that's going to families, quite honestly, didn't include a housing voucher that went to at least pay a portion of rent. That's unfortunate, though. I've seen some proposals for the next one that includes something like that, but we're still a ways off from, you know, stimulus number 4. But I do think that we have to be patient, and we should wait and see what happens by mid to end April and see what everybody's coming back with numbers. And it's going to be different in different, you know, parts of the country.
Yeah, McConnell said he's wants to wait until this one gets into the system first, but they want to do anything else, which is a wise move.
And I was on a call, I was on a GoToMeeting call or a Zoom call, I think on I think today's Thursday. Every day seems like Monday now. I was on a call on Tuesday, and there were about 60 investors, a couple other lawyers, and it was basically a call to basically unify to Dallas City Council because they're suggesting a 60 to 90 day moratorium on evictions now. And it was very interesting to kind of hear. A lot of these were smaller investors. Maybe they had 20 units, maybe they had five residentials, and some had a couple thousand units, 1,000 door deals as well. And it was very interesting to kind of hear what's going on. 3 of the guys had the ear of 3 different council members, and 2 are for this moratorium, and 1 says absolutely not, it'll kill everybody. Then you have Freddie. I know we're not talking about this on this webinar, but then you have forbearance agreements, or I should say provisions, because no one's actually signed an agreement that I'm aware of, by Freddie and Fannie that have 90-day forbearance, so you don't have to pay your rent for your mortgage for 90 days, but then you've got to pay those 3 months, 1/12 over the following 12 months. So which you think, okay, maybe that's fine, but you can't evict anybody during those 3 months, and you're not allowed to evict anybody during the 12 months that you're paying back the forbearance. So if you guys think about it, at least in the terms today, I guarantee these terms are going to lighten up when the banks feel pressure. But if you think about it, so you're now going to be in a 15-month period where you can't evict anybody because you signed the forbearance agreement. And if you think some of the tenants won't take advantage of that, and I'm not saying all tenants are bad, but some might. So now you're in a period where, okay, yeah, you didn't have to pay mortgage, April, May, and June, but starting July, you're paying mortgage plus 1/12. But meanwhile, those that know that there's a 4-month moratorium on evictions, if you have a Freddie or Fannie loan right now, they decide I'm not going to pay rent right now. Then they can work the system. If they find out you got a forbearance agreement, they can, in theory, not pay rent for 15 months. And so not only does that really piss you off, that's income that you're not getting to help cover that increase in mortgage that you have to pay because you took the forbearance agreements. So right now I go back to, and I've got a whole thing I'm doing tomorrow night online, but forbearance agreements are the most, right now, have the most draconian provisions you can imagine. They're horrible. We're advising all clients not to do anything yet. There's so many options you can do before doing a forbearance agreement. Forbearance agreement is the next step to a bankruptcy. There's no question about it. You are going to run the risk of going into a sinkhole that you cannot get out of. But I'm not talking about that tonight. We're talking about happy things, buying properties.
Actually, I have a quick question for you, Merrill. Say, for instance, you had a signed PSA, but then it got put on pause, so to speak, because of the provisions based on the shelter in place and everything. But then you continue to see the collections fall, depending on, because nobody knows how long this is going to last. Is there anything in the language that you can write into the PSA or just a general contract that you could renegotiate based off the collections?
So that's a very good question. So what I write in my contracts sometimes are different than what our clients write in, because I'm one of those guys, I don't care if I lose the deal. The deal has to work for me. So I actually write in there, if my economic vacancy isn't 80% or higher, I get a reduction in purchase price, and it depends on the deal, each percent, because I know it's going to hit me on the financing side. So if it's going to hit me on the financing side because I drop below a certain percent, that seller's going to have to pay for it. Now, the flip side, they may throw a bunch of 30-day or 60-day leases in there. So there's a flip side to that. But as far as protections, that's one protection. The other protection always is we build into, I think, almost every one of our clients, I think it's $1,500, somewhere between $1,000 and $2,000 per unit that is not rent ready at close. So if you've got 20 units that are not considered rent ready, and you define that in the contract at close, you know, it's another 40 grand off or something like that. It's pennies, but what it does is it covers a good portion of whatever your make ready cost would have been. That's really not COVID related. However, it could be, because repair and maintenance people right now are scared to go on some of our properties. And so, like, me personally, I've got some properties that are just sitting there, and you know, it is what it is. I can't get anybody to go. We're replacing. I don't mind telling my own, not horror stories, but stories. We're replacing stairs, stairs on an entire building that's about a $300,000 project, and we're 1/4 of the way through it, and it's a Fannie requirement. And we just got notice, hey, because of there's a shelter in where this particular property is till May 4th. We're not starting work again till May 4th. So I'm fighting with the contractor because we have 2 on the 3rd floor that are partially completed with no railing. And they're going to get out there and make it safe. I don't care if they finish it or not, but they're going to make it safe. But we just got that notice right before this this call. So anyway, I don't know if I answered your question, Hayden.
Yeah, I think so.
Okay.
Doug, did you have a question? Oh. Hey, oops.
Yes, I did. Thanks. I have 2 non-agency loans, and the bank has come back and said, we'll give you 3 months of forbearance. We'll tack it on the end of the loan. There's no issue in terms of evictions. They don't put a clause on that. What would be the downside of something like that?
Well, because you've stated something that equates to about 3 sentences, and my guess is your forbearance agreement will be longer than 3 sentences. So I hate to use a lawyer's term, the devil's in the details, but the devil's in the details. On its face, that sounds great. Tacking it onto the back, not sure what that means. If someone said tacking on the back to me, I would assume, okay, I have 270 payments left. I don't make the next 3, so I really have not 273 payments. I just push my 270 back 3 months. So my fear is like Freddie or Fannie, where they're taking those 3 months and they're just adding them to the next 12 months, or they're adding them back as a principal. So I would be very cautious, number 1, about that. Number 2, whether they have any cash collateral accounts requirements in there, whether they include any sweeping accounts in there. You may already have that in your loan docs. So just keep in mind, when you ask for forbearance agreement, you're in default. So I would highly recommend that when negotiating a forbearance agreement, and if anybody tells you they're non-negotiable, go to a different lawyer. Okay. But when negotiating it, make it very clear that the bank is not recognizing that you're in default because of conditions that are under your control. And I would also add that I haven't seen anybody that's been approved to get a draft of a forbearance agreement yet that hasn't shown they don't have the ability to make their mortgage payment.
I see. And so you have to pretty much show you need it, or else they're not going to give you the kind of terms I just mentioned.
That's my experience. If you can get those terms and you don't have to show need, and there's no personal guarantee or recourse, I don't know if your loan is already recourse or not, but if there's no recourse, on its face, it sounds, go ahead.
Yeah, they're recourse. So.
Okay, well, that's why the lender is willing to do that.
Yeah, there you go.
Yeah, because they've got you either way.
Right.
So, and Doug, I didn't realize that was a recourse loan, so it's probably not a bad deal because the lender is not really in any worse position. They don't want to see you end up doing something that adversely affects you because, well, you may not technically be able to pay off the entire loan. They still look at you for a partial payment if it goes south. and putting you in a position that doesn't allow you to cure your own default is not good business for them. So you're a little different. None of us, or not none of us, a lot of people are non-recourse loans. So they're going to try to get you any way they can.
You know, I refinanced recently into a recourse and took out a ton of cash. So I'm fine for a long time, but they just, you know, you reach out proactively, they offered it. I'm just kind of sitting there going,
So it's funny you say that. So, I mean, full disclosure, again, I'm transparent. So I went and, I mean, I've got a law firm, a title company, a brokerage, and I've got a couple funds, and then I have a software company. Well, right now, none of them are doing a whole lot because everybody's kind of in a holding period. And I've got 19 employees. So I actually have already filled out the small business SBA application.
Right.
I haven't sent it in. It's not, I can't send it in until April 3rd. They're not accepting them until Friday. I haven't sent it in yet, but I am trying to be proactive. If things go farther south, I'm going to send it in. And there's another thing. I don't know if any of you guys that have small businesses or property management companies or employees, and you're in Texas, the Texas Workforce Commission has a disaster kind of relief fund where they will pay 25% of your employees' salaries if, here's the if you retain your employees and you decrease their salaries by 25 to 40%, but keep their hours the same, they come in and they will fill the gap. So I filled that out myself too, in preparation, kind of like you. I want to know what my options are, but those are not options I want to utilize yet. I think the options are going to get better.
So Merrill, I was thinking the same. The EIDC, the Economic Impact, Disaster Fund.
Yep.
I've been hearing from other investors and multifamily owners that you can potentially use that for lost income, just as a LLC, as a sole member.
You might be able to. You might be able to. You need to. You've got to have very good books. You're going to have to show that you were profitable up until this.
So maybe let some time go by.
Again, that kind of goes back to what I tell everybody. Patience. I finish almost every one of my Facebook posts with patience. You know, there's lots of stuff coming out and people are freaking out about the terms of forbearance and everything. But 3 weeks ago, we didn't have anybody offering anything. And so financially, other than people being laid off, nothing has really happened in our world on this call yet. But yet banks are already seeing what can happen. The government is already seeing what can happen. So this is just a series of levels of fear. And so when they start seeing realities, good or bad, you'll see the markets start to calm down. You'll see more even-keeled minds up in our government, to the extent there might be some, start working together and are not just kind of trying to throw water on a fire, or actually trying to build something back. I think we're going to see it. I would encourage everybody to not jump into anything right away, unless you're in absolute dire need. If you're in absolute dire need, you need to not be talking to a syndicator or a real estate lawyer. You need to be talking to, this is not a plug for me, but clearly we can help you guys, but you need to be talking to somebody who has experience in restructuring and bankruptcy. And it's a bad word, but all bankruptcy is federal regulated court structured refinancing. You don't want to be there. There's some there's some things you do there that you can't turn around, but forbearance agreements would be the last thing I would do. I would first look at a capital call, 100%. Nobody wants to lose their capital. And if you have enough investors in your deal, each person putting in $5,000 or $10,000 to cover the gap stop, versus a forbearance agreement that could throw you guys into a bankruptcy, and a bankruptcy could wipe out 100% of the capital, 100% of the equity. Equity is the first thing to get wiped out in bankruptcy. So you have that, you have managers, and you have other investors that are potentially higher net worth. that can make a loan unsecured to the fund that doesn't violate your loan docs, and they just get paid back first upon the necessary cash flow, expendable cash flow. They get paid first. It's just kind of like a preference payment. And then if those don't work, then you start looking at a forbearance agreement. Your investors are going to be much friendlier to you than any bank will ever be, guaranteed, especially in a period like right now. So why everybody's jumping at forbearance agreements blows me away. That was not a dig on you.
Any other questions?
I think, Dustin, if you go to the next slide too, we have all of Merrill's contact information. If anybody, thinks of somewhere down the road. Yeah, there we go.
You guys are welcome if you want to share this with the group. I don't have any problem with it.
Okay. Yeah, we'll do. I'd actually gotten some requests for that. So, yep. Awesome.
Yeah, we'll send out the recording, and then we'll send out Merrill's presentation that's got all his info on it too. So everybody will have it.
Okay. Well, unless anybody has any other questions, anything you want to end with, Merrill, or wrap it up?
Sure. Listen, I really appreciate Dustin Hayden having me on. Dustin's been a client of ours for a long period of time, and I had the good fortune meeting with Hayden several months ago. It's exciting to see what you guys are doing. Again, I think everybody, if they can honestly take a couple deep breaths, go walk around outside, burn off some of the energy, stop watching CNN and Fox every 5 seconds. I know it's hard to do. And just try to relax. This will pass. It's just a matter of when, but it will pass. There's some opportunities out there. Just don't start firing shots today. Get some advice, talk to people. Sometimes it's helpful. Talk to your competitors. Your competitors are your friends right now. Everybody's in the same boat. So highly recommend, especially these conferences that Dustin and Hayden put together. They're really good. And next time I would encourage everybody to ask questions about anything, because I guarantee you half of you are thinking the same thing. So just keep up the good work, and you guys are welcome to reach out to me if you need anything. And again, thank you to Dustin and Hayden for having me.
Well, enjoy the beach, Merrill.
Yeah, I wish. Bye, guys.
Yeah, I appreciate it. Take care, everyone. Have a good night.
Thank you.